Why your savings are trapped. The 2026 crash versus 1929. In 1929, when people sensed danger, they walked into a bank and walked out with their money. They did not need permission. They did not wait in a digital queue. They acted, and action saved them. In 2026, a person may sense danger earlier than everyone else. They may understand what is coming. They may decide to protect what they have earned. But the system may not allow them to move. No locked doors. No panic in the streets. Only screens, rules, delays, and silent barriers that appear exactly when they matter most. This is not a story about a market crash. It is a story about escape being removed before people realize they need it. And by the time most understand what is happening, their savings may already be out of reach. In the early months of 1929, most people believed the financial system was strong. Businesses were growing, markets were rising, and confidence filled the newspapers. Very few questioned whether this growth was real or sustainable. Debt was increasing, speculation was common, and risk was hidden under optimism. Still, people trusted one simple idea. If trouble came, they could take their money and protect themselves. Savings at that time felt real. Money could be held, moved, and stored without delay. Ownership was clear. A person either had their money or they did not. Even when banks failed, control was personal. Those who acted early survived not because they were smarter, but because they were faster. Today, the world looks more advanced. Technology is faster, markets are global, systems are complex and highly regulated. People are told their savings are safer than ever. Accounts are insured, risks are managed, professionals are in control. On the surface, everything appears stable. But stability is not the same as control. Modern savings do not sit in cash. They exist inside systems. Retirement accounts, investment platforms, and digital records hold value, but access depends on rules. Withdrawals follow procedures. Transfers take time. Penalties discourage early action. Ownership has quietly shifted into permission. This change was intentional. After past crashes, leaders concluded that individual action made crises worse. When too many people tried to protect themselves at once, systems collapsed. The solution was not to improve access, but to slow it down. The goal became system stability, even if that meant limiting personal choice during stress. As a result, modern finance works smoothly in calm times and tightly in uncertain ones. The restrictions are not obvious when conditions are normal. They appear only when everyone wants to move at the same time. This creates an illusion of safety. There are fewer visible panics and fewer dramatic failures. But quiet does not mean free. It often means controlled. In the modern system, time has become a tool. Withdrawals take days. Reviews appear without warning. Delays are justified as protection. Each rule seems reasonable alone. Together, they remove speed from personal decision-making. For business owners and professionals, this creates a serious risk. They may understand markets. They may see warning signs early. But knowing is no longer enough. The ability to act matters more than awareness. When access is delayed, insight loses value. This is the real difference between 1929 and 2026. In the past, people failed because they saw danger too late. In the future, many may fail because they are unable to move even when they see it early. Savings today are governed, not just stored. When pressure rises, systems do not collapse outward. They tighten inward. What looks like protection becomes containment. Part 1 reveals a simple truth. Risk was not removed from the system. It was relocated. The greatest danger is no longer sudden loss alone, but delayed access. And when access disappears, even temporarily, the damage can be permanent. The question facing individuals today is not whether another crisis will come. It is whether they truly understand the system holding their savings before that system decides for them. They did not call it a lock. They called it protection. After the shock of 1929, governments, banks, and regulators studied one question more than any other. How did ordinary people make the crisis worse without meaning to? The answer was uncomfortable. When fear spread, people acted rationally for themselves. They rushed to withdraw money, reduce exposure, and protect what they had earned. Individually, those actions made sense. Collectively, they broke the system. So the system learned. Over the decades that followed, finance was redesigned with a quiet goal: to slow people down when panic appeared. Not by force, not by visible barriers, but by structure. In the old world, money moved by hand. Cash could be withdrawn in minutes. Decisions were final and immediate. A person who sensed danger early could act early. Speed belonged to the individual. In the modern world, speed belongs to the system. Every major reform after past crises pushed finance toward delay. Settlement periods were introduced, withdrawal rules were expanded, penalties were added, compliance layers multiplied. Each change was explained as safety. Each change reduced personal control. At first, these systems worked well. They prevented sudden collapses. They gave institutions time to respond. Markets became calmer on the surface. Crashes looked less violent, more managed. This created confidence, but confidence came at a cost. The modern saver does not truly hold money. They hold a claim. The claim must pass through procedures before becoming usable. Under normal conditions, those procedures feel invisible. Under stress, they become gates. A bank no longer needs to fail for access to disappear. A platform does not need to collapse for withdrawals to slow. All that is required is unusual market conditions. That phrase appears quietly in user agreements, policies, and legal documents that few people read. When stress rises, these conditions are triggered automatically. This is the shift from bank runs to system locks. In 1929, the danger was obvious. People lined up outside banks, doors closed. Panic was visible and public. Today, danger is administrative. Screens still work. Accounts still show balances. But action is postponed. The delay is the defense. Financial authorities learned that panic spreads faster than insolvency. If people cannot move quickly, panic loses power. From the system's perspective, this is success. From the individual's perspective, it is captivity. What makes this model dangerous is that it feels fair. Everyone is treated the same. Rules apply equally. There is no villain, no obvious injustice, just process. For business owners, this creates a hidden exposure. A company may appear well capitalized on paper. Its assets may be diversified. Its accounts may show strength. Yet, if cash cannot be accessed when needed, none of that matters. Liquidity is not wealth, it is permission. During stress, permission is rationed. Credit lines can be paused, transfers can be reviewed, withdrawals can be delayed. None of these actions are described as failures. They are described as safeguards. But safeguards for whom? The system prioritizes continuity. It must keep markets functioning, institutions solvent, and confidence intact. Individual outcomes are secondary. This is why modern crises feel slow at first. There is no sudden collapse. Instead, there is friction. Time stretches, decisions are deferred, people wait for processing, approval, and clearance. Waiting becomes the risk. Those who understand this early attempt to move before restrictions tighten. Those who wait for confirmation discover that confirmation arrives only after access is gone. In this way, modern finance rewards anticipation but punishes reaction. The greatest misunderstanding among the public is believing that regulations exist to protect individuals. In reality, they exist to protect systems from individual behavior. This distinction is rarely stated openly, but it shapes every rule. The system assumes that individuals will act emotionally under stress. Therefore, it removes the ability to act quickly at all. This creates a quiet transfer of power. Judgment moves away from people and toward automated frameworks. Algorithms, policies, and protocols decide what is allowed and when. By the time a crisis is visible to everyone, these controls are already active. This is why comparisons to 1929 are misleading if taken at face value. The danger today is not mass panic on the streets. It is silent restriction behind screens. There may be no lines outside banks, no headlines screaming collapse, just messages saying processing, pending, or temporarily unavailable. And for those who depend on timing, entrepreneurs, investors, business owners, timing is everything. Part 2 reveals a critical reality. Modern finance does not collapse outward. It tightens inward. It absorbs shock by limiting motion. And in doing so, it changes who survives stress and who does not. The question is no longer whether systems can fail. It is whether individuals can move when they need to. And that question leads directly to the new risks facing those who build, invest, and operate businesses in this environment. For entrepreneurs and business owners, danger rarely arrives as a headline. It arrives as a delay. In the modern economy, businesses are built on timing. Payroll must clear on exact dates. Suppliers expect payment on schedule. Credit obligations follow strict calendars. Growth plans assume that capital, when needed, will be available. This assumption worked in stable conditions. It becomes fragile under stress. In earlier eras, a business owner measured risk by balance sheets and market demand. Today, another factor quietly dominates everything else: access speed. It is not enough to have assets. It is not enough to show profitability. What matters is how quickly money can be reached when pressure rises. This is where the modern system introduces a new form of vulnerability. An entrepreneur may diversify investments, hold reserves, and maintain strong banking relationships. On paper, the business appears resilient. But if reserves are held inside systems that slow or restrict movement during volatility, resilience becomes theoretical. Liquidity becomes conditional. During periods of financial stress, institutions protect themselves first. Credit lines are reviewed. Lending standards tighten. Risk models adjust overnight. None of this requires a collapse. It only requires uncertainty. For a growing business, uncertainty is enough to trigger a chain reaction. A delayed transfer can disrupt payroll. A paused credit facility can interrupt supply chains. A frozen withdrawal can force difficult decisions within days. These are not dramatic failures. They are operational breakdowns, and they spread quietly. What makes this risk especially dangerous is that it cannot be hedged easily. Insurance does not cover timing. Diversification does not guarantee access. Even strong cash positions can become illiquid if the system decides to slow. Many entrepreneurs assume that because they are not speculators, they are protected. This is a mistake. System stress does not distinguish between intent. It responds to exposure. Modern finance is deeply interconnected. One institution's caution becomes another's delay. One market's volatility triggers reviews across platforms. The result is a synchronized tightening that feels sudden to those experiencing it. By the time a business owner realizes access is restricted, options have already narrowed. Another overlooked risk is counterparty dependence. Businesses rely on banks, processors, and platforms to function daily. When those entities activate defensive measures, businesses inherit their constraints. The risk is not failure, but hesitation. Hesitation costs time. Time costs trust. Trust costs revenue. Younger entrepreneurs are particularly exposed. They operate in a digital-first environment where money is abstract. Funds move with a click until they don't. Many have never experienced a true liquidity event. Their confidence is based on speed they have only seen in good times. But systems are designed differently under stress. Growth-focused businesses also face a structural mismatch. They invest in long-term opportunities while relying on short-term access. This works only if access remains reliable. When that reliability disappears, long-term planning becomes relevant. The system does not warn when this shift happens. There is no announcement, no official moment of transition. Controls activate quietly, often justified as routine reviews or standard procedures. For decision makers, this creates a false sense of time. They believe they have days or weeks. In reality, the critical window may already be closing. This is why traditional risk management fails in modern crises. Models focus on price, demand, and leverage. They rarely account for access constraints imposed externally. Yet, these constraints determine survival. The most dangerous position is not being wrong about the market. It is being right too late. Businesses that survive stress are not always the strongest or smartest. They are the ones positioned to move early. They understand that waiting for clarity is a luxury the system does not offer. In 1929, those who acted early escaped because they trusted their instincts. In the modern era, instinct alone is not enough. Structure matters more than insight. Part 3 exposes a harsh truth for entrepreneurs and business leaders. Modern risk is not symmetrical. It does not give equal time to all participants. It favors those who understand the mechanics of restriction before they are visible. The question facing every business today is not whether growth is possible. It is whether access will exist when growth needs to be defended. And that leads to the final escalation, why the next crisis will not look like the last one, and why preparation must be redefined before it arrives. History often misleads by familiarity. When people hear another crash, they imagine a repeat, falling prices, panic selling, headlines filled with fear. But the next crisis will not follow that script. It will be quieter, faster, and far more controlled. The comparison between 1929 and 2026 is not about scale. It is about design. In 1929, the system reacted after the damage was done. Rules were written in response to collapse. Today, rules are designed to activate before collapse becomes visible. This is the fundamental escalation. Modern financial systems are built to sense stress early. Algorithms monitor liquidity, volatility, and behavior in real time. When thresholds are crossed, automatic responses follow. These responses do not wait for public panic. They anticipate it. Speed, once an advantage for individuals, now works against them. The moment instability is detected, protective measures engage. Transfers slow. Withdrawals are reviewed. Limits are adjusted. None of this is framed as emergency action. It is described as standard risk management. This creates a new kind of crisis, one without a clear beginning. There is no single day when everything breaks. Instead, access gradually tightens. Each restriction seems temporary. Each delay appears minor. But together, they form a barrier that is difficult to cross once fully in place. In this environment, foresight loses power. Seeing danger early does not guarantee escape. Action must occur before signals become obvious enough to trigger controls. This compresses the window of opportunity. In 1929, awareness came too late for most people. In the modern era, awareness may come early, but access disappears even earlier. This is why 2026 is not a repeat. It is an escalation. Digital finance has removed friction during growth and added friction during stress. This asymmetry benefits stability at the system level while reducing flexibility at the individual level. The system absorbs shock by slowing everyone down at once. From a regulatory perspective, this is progress. From a personal perspective, it is confinement. Another key difference lies in uniformity. In the past, outcomes varied widely. Some banks failed, others survived. Some regions collapsed faster than others. Today, financial responses are synchronized. Platforms follow similar rules. Institutions share risk models. Decisions propagate instantly. This uniformity reduces chaos, but it also removes alternative paths. When one exit closes, others often close with it, Preparedness, therefore, cannot rely on prediction alone. Predicting timing is less useful than understanding structure. The system does not reward those who guess correctly. It rewards those who are positioned correctly before guessing is required. This shifts the definition of financial intelligence. It is no longer enough to understand markets. One must understand mechanisms. How quickly can capital move? Under what conditions can it be delayed? Who controls the switch? These questions matter more than forecasts. The modern system assumes that collective stability outweighs individual choice during stress. This assumption is unlikely to change. If anything, it will strengthen as systems become more automated and interconnected. The result is a future where crises are managed, not resolved, where damage is distributed through restriction rather than collapse, where loss comes not from sudden destruction, but from missed opportunity and forced waiting. The greatest risk in 2026 is not losing everything overnight. It is being unable to act while value erodes slowly. This makes the next crisis harder to recognize and harder to escape. There will be fewer warning signs, fewer dramatic signals, and fewer moments of obvious failure. Most people will realize what is happening only after options are limited. Part 4 completes the warning. The financial world has evolved to survive stress by controlling movement. Those who depend on speed, flexibility, and independent judgment must adapt to this reality. The lesson of 1929 was that panic destroys systems. The lesson of the next crisis may be that systems now prevent escape, and understanding that difference is no longer optional.